I wanted to start by asking you about the period, I guess 30 years ago, around late 1992, when you were working as an engineer and you first fell in love with investing. What happened that set you on this immensely successful 30-year journey that you've been on as an investor?
Well, I believe the first book I read was One Up on Wall Street by Peter Lynch. And it was the first time really that I read about value investing. The idea that a company has a value and you can purchase it on the stock market way below its intrinsic value. And to me, that was something new because I didn't have any strategy for investing or any idea how investing worked. To me, it almost looked like a casino and was dominated by financial sharks. So overnight, my views of what the stock market was really changed when I read the One Up on Wall Street. And then it led to read Ben Graham book, The Intelligent Investor, and then went on Warren Buffett's annual letters. And really reading those annual letters, probably at the beginning of 1990s, really changed my whole views of the investment world. But more importantly, it gave me a real passion to invest in the stock market.
You had a very scientific background. I remember once reading that you were obsessed with abstruse sort of physics theorems and the like, and you'd come out of college and become an engineer, right? But then as a child, if I remember rightly, back when you were about 11 or 12, you were already kind of fascinated by the numbers of stocks kind of moving up and down in the papers. What do you think it was that kind of inherently fascinated you about the stock market from such an early age?
Well, I guess, like you say, in those days, you read the market quotes in the newspaper, so you have all those big pages of small numbers going up or, a quarter going down a quarter. And I just found that fascinating. I didn't know exactly what it meant, but I thought all those little numbers interested me a lot. And I had interests from, as you said, I became an engineer. And even though I was interested in the stock market pretty young, I used to play a board game called Stock Ticker. We have dices and you would own shares of, grains or industrial products. And I found that board game so fascinating that I remember I made a version on a computer much more sophisticated. So it got even more interested. But I think the view at that time to me is that the prices of the stock market was really, when I programmed it on the computer, I used random formulas. So it was just like a casino. So things would go up and down based just on the odds of hitting the right numbers. So to me, science, physics, and mathematics through engineering was a more rational way of earning a living. But when later, because of Buffett and Graham and Peter Lynch, I discovered that you could use your rationality and to analyze companies and understand the values of companies. It struck a chord with me because I was someone that liked to understand things and I wanted things to make sense.
You were also obviously pretty obsessive because I remember you once telling me that you, I think, read Peter Lynch's other famous book, Beating the Street, something like 10 times in your youth. And then I think, as I remember from our last interview, you started to read Buffett. And then I think in early 1993, you told me you actually wrote to him and he sent you all of these annual reports for this stack from like 1977 to 1992. I mean, that's kind of an extraordinary thing to do as well, right? What were you thinking in writing to Buffett? And then what did you actually learn once you started to really dig into those 15 years of annual reports?
Well, I think from a very early age, I was a self-learner. So I always wanted to know things by reading books or annual reports or anything. So pretty quickly, I understood that Warren Buffett was the great master of investing. So to me, to write him, to ask that he sends me everything that is written that is available was just a logical thing to do, just to study the great master. And to go back to the art analogy, I think if you want to become a great painter, you want to study the great masters of the past. So you go to museums and you just look at the Claude Monet, or Rembrandt, or Van Gogh, all those great artists, and you learn from them. And that's what I did when I started, and still doing it today.
So obviously, as an engineer, one of the things that presumably resonated for you was also this idea of the margin of safety, right? When Buffett and Munger talk about it, they would often talk about it in terms of a bridge.
Yeah.
Can you talk about that notion, which seems to me just vastly important?
Oh, yes, yes. And Ben Graham made it is key to value investing. Is he chose those three words, margin of safety. And, 70 years later, I think they're still the three right words. And yes, as an engineer, it's really resonated with me. And I would say that also this margin of safety principle, I think, can be extended to more than just valuation, but in terms of the quality of a business, the quality of managers, and the quality of balance sheets also. So we see it this year, the companies that have a little too much leverage on the balance sheet, they can be quite hurt by the increase of interest rates. So you want a margin of safety, not just on valuation, but on all the important part of running a corporation.
I also remember you once saying to me how this idea of the margin of safety really runs through every area of your life. I remember you, hopefully we'll get to talk more about your art collecting later, but I remember you saying to me once, you bought some great piece of art and you timed it, the payment over 4 years in some interest-free way. And so you were kind of keeping the commitments down. And likewise with the cost of your office and the like, you were very careful. I think you once said to me that if your revenues dropped by 80%, you'd still survive. You'd still be able to hang in there. Is that fair to say that this idea of the margin of safety runs through pretty much your entire approach to life?
I think you have to. If you're in the investment business, probably over decades of investing, you'll go through a very tough time at some point, the market being down 50%. So revenues down 50%, it hurts a lot of companies. So your goal is to be able to survive such period, even if it happens only once in your career. So from day one, I've been always very, very prudent and always have a margin safety in terms of keeping expenses no more than 50% of revenues.
So to go back to day one, you started investing money for your family in July 1993, and you launched what was called the Rochon Global Portfolio. And at the time, you were still working as an engineer during the week, and you were kind of moonlighting as an investor on weekends and in the evenings. And if I remember rightly, you were spending your Sundays at the library reading Value Line and annual reports and the like.
Yeah.
Was it a very joyful experience? I mean, were you just sort of intoxicated by by what you were reading of Buffett and Graham and Lynch and the like?
Oh, it was. It was really like discovering how to turn lead into gold. That was a feeling that obviously I didn't have that much experience yet. So I was perhaps a little naive, but that was an exciting period, very excited. And I do remember reading old value lines from the 60s, from the 70s and 80s, and, trying to identify companies that at some point were trading at very, very low valuation and studying afterward what had happened to those investments. And I remember reading, I think, the 1973 or 74 value line H&R Block, and I think the stock went down 80% in the correction of 73, 74. And at some point, I think it traded at, 4 or 5 times earnings. So these were exciting times because I discovered that if you could identify great companies and, be able to purchase them at reasonable valuation, you could do very, very well. And I would say at the beginning, it still happens today, but in the beginnings, you could find some very great companies trading at very, very low valuations. And so, when I started to really purchase companies, the first few years, I did very, very well because there were great opportunities in those days. I'm not saying there's not anymore. Let's say it's a little harder today than it was probably 93, 94.
So you quit engineering after maybe 3 years of discovering the joy of real serious investing and went to work for an investment firm in Montreal. I have the sense that it was a disillusioning experience and showed you a lot about the disadvantages of institutional money management. Can you talk about what happened, what you saw there that made you think, yeah, I want to be in this business, but I want to work for myself so I can follow the rules that I want to follow instead of doing it in this misguided way?
Well, I don't know if it's misguided. I think most money managers are sincere doing their best. I really do. And so when I worked at that big firm that managed institutional clients, they did the best they could. And, they had pressure from the clients to do well on a quarterly basis or at least on a yearly basis. So I just realized in real life, I wouldn't say I lost illusions. I just realized that in real life, it's hard to have a long-term horizon. Your clients, in those cases, the institutional clients, have to share your time horizon for the relationship to work. Because if your clients don't give you the time horizon you need to get the rewards from equity investing, it's a wasted time to invest that way. So I realized that most people in the business have the luxury of having a long-term horizon. So, when I realized that, I said, well, if I really want to invest the way I believe is the best way to invest, I have to start my own firm. And when I started to gather clients in the early 2000s, I really took the time to explain to all those clients that we needed to have both of us have a long-term horizon and not to focus too much on the short-term results. And I don't know exactly when I started to talk about my rule of three, but pretty early on, I taught the importance of that rule, and which is basically 1 year out of 3, the stock market will go down. 1 stock out of 3 that you'll purchase will be a disappointment. And at least 1 year out of 3, you'll underperform the index. And I think when you accept that from the start, you deal better with market fluctuations, the mistakes you'll make in securities, and you have to accept from the start that you'll have years you'll underperform the market. Even if you do a good job and you studied a company very well and made some intelligent long-term choices, you can have 2 or 3 years in a row that you underperform, and you have to be able to accept that.
It seems also that rule of 3 is a fundamental reminder that you need to be humble as an investor, that a third of the stocks you purchase are likely to do poorly. A third of the time you're going to underperform the index, and a third of the years the stock market's going to fall by 10% or more. It's kind of wiring yourself in a way from the start, conditioning yourself from the start to have fairly realistic and humble expectations about the roughness of the terrain you're going to have to navigate.
Oh, yes. And I think as the years go by, I think it's very hard not to stay humble and get even a little more humble, because it's a very tough industry. It's a very tough, when you want to beat the stock market over many years, not just 3 or 4 years, but over decades. I think you have to be armed with a lot of humility. And I think humility is kind of the catalyst to help you become a better investor, because you always want to learn more and understand more. It turns out that it's kind of a good tool to help in the learning process.
There's a very fundamental insight at the heart of your approach to investing, which comes up again and again in your letters to shareholders, your quarterly letters, your annual letters, which I've spent the last few days reading with great interest. They're fantastic letters.
Thank you.
And the insight really, which sounds so obvious, but that you've helped me to kind of pound into my own head, is, as you put it, that the stock market always reflects the fair value of companies over the long term. Can you talk about this idea of the convergence of a company's intrinsic value and its stock market value over time, Because it seems to me an absolutely foundational insight that most investors who are treating the market as a casino simply don't understand. And once you understand it, it's a little bit like understanding the laws of physics, right?
Yeah. Well, I think there's a kind of, with the stock market, there's a kind of a paradox because in the short term, and short term can be a few years, in the short term, the quotations of any stocks or even the general stock market can be irrational, unpredictable, and totally out of sync with the intrinsic value. But in the longer term, all the forces seems to balance themselves, and every quotation in the stock market eventually will affect the intrinsic value of a company, any company. I don't think there's any exceptions. So this paradox, once I believe you understand that, you can see that the key ingredients is first to understand the businesses you invest in so you can have a general view of what you think it's worth. But the second part, you have to be patient. You have to accept that it can take some years for the rewards to return to you in terms of a good return in the stock market. But I think here lies the key way to deal with this paradox. You have to consider yourself as an owner of the shares of the company you own. And since I think I started in 1996, I was inspired by Warren Buffett, of course. I started to measure the owner's earnings of the companies in the portfolio. So put very simply, I would say that I would try to see my portfolio as a holding of companies and try to measure how much the intrinsic value of the portfolio has increased the 1 year compared to the previous year. And this is done very simply by just adding the earnings of all the companies you own and compare it with the previous year. By doing this, I think I help myself get more impervious to market quotations. And I know that over the long many years, if I'm right in the owner earnings part, the quotation of the stock market will eventually reflect that. And so far, my experience has been since 96 that there's been a very strong correlation between the increase of the owners owning the companies we own and the quotation in the stock market.
The correlation is so striking when I look at your shareholder letters that it's worth actually kind of dwelling on the numbers. There was one point in one of the letters where you said over 20 years from 1996 to the end of 2015, your company's intrinsic value increased by 1,102%, and the value of their stocks increased by 1,141%. So incredibly close, 1,102% for the increase in intrinsic value, 1,141% for the increase in the value of the stock. So as you point out again and again in the shareholder letters, this is not a coincidence. The correlation is kind of amazing.
It is amazing. It is, I think, the fundamental process that lies behind the approach of value investing. If the value increases by, let's say, 1,000% over 20 years, the market will increase the value of the stocks by 1,000%. But over a year or two or three, anything can happen. So that's why I say it's kind of a paradox. But if you keep focusing on what's happening to the companies you own, eventually the stock market will reflect it.
So one of the things that seems, if I understand this correctly, to be fundamental to your approach is that you're looking for outstanding companies that basically are increasing their intrinsic value faster than the average. So if you expect, you often talk about how stocks historically maybe go up 6 or 7% a year in the US, and maybe there's a 2% dividend, something like that. So let's say historically you'd expect an 8 or 9% return. What you're looking for is outstanding companies that can grow maybe 5 percentage points faster than that. Is that a fair summary of what seems like a pretty simple approach, but obviously is incredibly difficult to pull off?
It is. It is what I'm aiming for. I don't remember exactly, but I think since 96, the increase in the owner's earning of the portfolio on average, and if you include the dividend, it's close to 13% annually. So it's probably a little more than 12% in terms of earnings per share growth, and perhaps less than 1% of dividend because many companies in the portfolio don't pay dividend. So that 13% is probably, like you say, 4 or 5% better than the average of the stock market. Let's say the S&P 500, which probably has grown exactly as you say, probably 9% over the last 25 years. That's what I'm trying to do when I purchase a stock for the portfolio. Find a company that I believe if you combine the earnings growth going forward and the dividend yield, you come close to 12, 13% annually.